What I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. I see us going to 140 or 150 this year pretty easily, and potentially higher. And that's why those of us who really understand it deeply, just are pounding the table that you've got to buy some of this because it's going to be so much higher.
Bitcoin by design is the antithesis of fiat money. It is capped at 21 million coins, making it immune to inflationary dilution. Unlike any other commodity, Bitcoin's supply does not increase in response to price. When gold or oil prices rise, more supply enters the market. Not so with Bitcoin. That makes it the premier hard money asset in a world drowning in fiat currency. Lepard predicts that Bitcoin will rise to the multi-million-dollar range per coin over the next 10 to 15 years. This isn't just a speculative moonshot. It's based on structural monetary imbalances and exponential adoption curves.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yes, it's an everything bubble. So the reason it's a bubble and the reason we got to this point, and it's useful to discuss this, is that they kept interest rates at zero from 2008 to 2015. Remember, they had ZIRP, which stands for zero interest rate policy. They also kept them at zero from 2019 to 2022. And that created an enormous, enormous bubble because money was free. And so people borrowed and then they used it to lever up and buy yielding assets. Okay. So the question of, do we need it to burst for Bitcoin to go to new highs? It's unclear. I mean, if the Fed just pivots and starts printing money, no. But what I see is that we've got a Fed chairman who wants to be Paul Volcker, who's determined to correct the excesses of the COVID print. And so he's being very tough about not dropping rates quickly. And my sense is that what that's going to lead to is that something's going to break. I mean, we know the third Fed mandate is if something breaks, they will print money. We saw it in '08, we saw it in COVID. And so what I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. And at that point in time, the Fed will suddenly pivot and say, well, we're trying to fight inflation, but we can't let the system fall apart. And therefore, we need to reinstitute quantitative easing. We need to, use yield curve control to cap the interest rates on the bond market. And we stand ready to buy whatever bonds are being sold by the market. I think that's what we have in our future. Now, what's really tough also is just, we don't know when that's going to happen. It could happen tomorrow. I mean, I can't see it happening, taking more than 2 years, but I give it could happen. They could drag this out for a while. It could be 18 months or so before it happens. But I think what we do know because of the math is that it has to happen because without more money in the system, you don't have the capital to pay the interest on the growing bond balances. So it's really kind of a problem. The biggest picture, I think, is just continual monetary debasement. That's kind of, the book describes this as kind of just baked in the cake. This is Lynn's model, and it's been my model as well, that when you're expanding debt and you're expanding the monetary base more quickly than you're expanding GDP, that's an inflationary thing. And Bitcoin is fixed algorithmically to 21 million coins, so it will not expand as all these other monetary base expand. So in dollar terms, Bitcoin, I'm with Saylor, Bitcoin is going much, much higher. It's going to multiple millions of dollars per coin over the next 10 to 15 years. So I'd say but to point to the biggest cause is because the fiat system and the Keynesian model really just kind of requires continued inflation. And there was a time when that was, calmer and people weren't paying attention to it, like the 80s, after we had the gold rush in the 70s, and then Volcker got things under control. And, most people weren't paying attention to sound money during the 80s. But, it's gotten steadily worse, this issue of government spending and debt. And I think now we're kind of at the point where the pot is really on the boil. It's happening very quickly now. And as we all know, we hit a record high price today at 109, and I see us going to 140 or 150 this year pretty easily, and potentially higher. But I'm very comfortable predicting that. Don't sell your Bitcoin and get off. If you don't have any Bitcoin, get off of zero. I mean, to me, this is an opportunity that your grandkids will, remember, and don't mess it up. I mean, it's really, it's a very unique and rare time that we live in. You're not too late. 109 is not too much to pay. When the coins are 1 million or 5 million, you'll feel like you were a genius that you bought it at 100. So, get your coins, buy whatever you can afford to buy. And that's why this thing is so unique. I mean, so this is the best performing financial asset in the history of financial assets. Nothing else has ever done this. And so it's very hard. I mean, imagine the early 1900s, you didn't think people could fly. Suddenly you saw an airplane. You're like, what the hell? I mean, it's the same kind of thing. It's something really unique and different. Let me explain why. So every commodity in the world is responsive to price. Okay. In other words, the price of gold doubles, we'll mine more gold. The price of oil goes up, we'll drill more oil. The price of corn goes up, we'll plant more corn. You can, and the supply will bring the price back down. Remember, here we got a commodity, all Bitcoins are interchangeable, where the supply is fixed. So if the price goes up, we don't get any more of it. The price just goes up. So, that's what makes it so incredibly unique. And I think so hard for many, many people and TradFi people to get their head around. Do you know what I mean? And that's why those of us who really understand it deeply, just are pounding the table that you've got to buy some of this because it's going to be so much higher and you're going to have enormous regret. I mean, if you're looking at it at 109,000 right now, and in 5 or 10 years it's at 2 million and you knew about it, but you didn't buy it, you're going to experience regret. Now, I'm not saying you got to take your entire net worth and buy it. No. You got to, I always just try and say, get off of zero, take a 1% allocation, take a 5% allocation, and then forget about it. That's the other great thing about it. Compared to companies where you got to read the reports and listen to management talk about it, you can buy this stuff, forget about it, go live your life. You wake up in 5 years, you're going to be richer.
Lepard introduces the idea of a mass-scale Gresham's Law event where bad money drives out good money. But in today's context, it's reversed. People are dumping bad money, fiat, and seeking good money, Bitcoin and gold. As more people realize that bonds and cash are long-term losers, there will be a widespread rotation into hard assets. Lepard acknowledges gold's historic role. It got us to 2008, but Bitcoin is the better choice for today's world due to its portability, divisibility, and network effects.
I think the trade wars actually kind of feed into all of this. I think all of the economic problems that are bubbling up all over the place, including the Japan bond market, which appears to be kind of in a state of falling apart, I think all of these feed Bitcoin. The Bitcoin the price used to be correlated with the S&P, or with the triple Qs and the NASDAQ, because it was kind of viewed as a risk-on asset. And I think we're in the process of seeing that change. I think it's now starting to trade more like digital gold. And what's going on is these two assets are really beginning to realize that the government is in a trap, that they just cannot stop printing money to keep the system running. And once that becomes widely known and understood, we'll have kind of what I call and describe in the book as a mass-scale Gresham's Law-like event where people want to get out of other assets, particularly bonds, that are denominated in a fiat currency and get into the two currencies that the government can't print, which are gold and Bitcoin. And I prefer Bitcoin to gold because it's got an adoption cycle and it's got so many advantages over gold. But I don't shit on gold. Gold's got merit. It got us all the way to 2008, and it's not going to disappear overnight. It'll still do a job of protecting some of your purchasing power, but Bitcoin's a much better choice. The most important macro indicator, well, there are 4 or 5 of them, but the price of gold. Notice it's hitting all-time record highs. A lot of people think, oh, it's just a bubble, it's going to come back down. No, it's not. It's going to go to 4,000, 5,000, ultimately 10,000 plus. The price of Bitcoin, same story. A few years ago it was 15,000, now it's at 109. I think it's going to 200, 400, 600 over time. The bond market, the long bond market, which tells you how much people trust that government bonds will hold their purchasing power. And what you're seeing there is in Japan, the 40-year bond is hitting record levels. In the United States, the 20-year bond just crossed the 5% mark, which is a big deal. And then probably finally, I would say, the stock market. The stock market's a little bit trickier to figure out, but it gives you a sense of how much liquidity is sloshing around in the system. And what I think is going to happen here is I think ultimately the stock market is going to start to go down. The U.S. bond market is already in the process of going down. Rates are going to go higher. And the government, the U.S. government really cannot handle higher interest rates. I mean, we are currently spending about $1.2 trillion a year on interest in the U.S. It's bigger than the defense budget. It's approaching the Social Security budget. And if interest rates keep going up, the government's going to, go bankrupt. I mean, they already are bankrupt, but it's going to be worse and obvious. And so what I think will happen is the government will be forced into what I call yield curve control, which is another round of quantitative easing, which is really just complicated words for saying they're going to hit the button on the computer that says print more money. And that's fine. It'll keep the system going. But that's what they did in the COVID example when they grew money supply 40% in 2 years. And that's why everybody, I don't know about you, but when I go to the grocery store, I get horrified. I mean, the cost of groceries is just insane. I mean, it went up so much in the last 3-4 years. It's been horrible. And so, and so I think we've got more of that in our future, sadly.
What are common mistakes you see younger investors making today?
Probably the most common one is the belief that the stock market can only go one way, and that's up. I've lived through a lot of cycles since the 70s, and a lot of people have been conditioned to just believe that the market is safe. The market goes up, you always buy the dip, and frankly, every time since 2008, it's been the right thing to do. Or 2009. But remember, when the dot-com bubble burst in 2000, when the housing bubble burst in 2008, stock market went down 50%, top to bottom, and tech stocks in the bubble, housing stocks went down 80 or 90%, and dot-com stocks went down 80%, and Nasdaq went down 80% in 2000. So I think that the average young person doesn't really appreciate what a bear market is because the printing has always solved that problem, and that may continue to be true. But I would just caution people that, if you look at the market today on historical metrics, and John Hussman is an analyst who does some fabulous work on this area. I mean, the stock market today is not even close to being cheap. In fact, it's extremely overvalued. So I think there's a possibility this next big print comes with a twist. And that twist is that, okay, things get troublesome. The bond market breaks, the stock market breaks, the Fed comes in, they print a ton of money. It certainly benefits gold. It certainly benefits Bitcoin because they represent forms of money that can't be printed. But it doesn't necessarily have to benefit stocks. I think you could see a situation where stocks don't go up as much as everyone's hoping, or they go sideways. I mean, and the reason for that is I think that what we'll be talking about when they do that print will be very disruptive to the economy, and it'll cause a lot of inflation. And if you look at the stock market, the last big period of inflation in the United States was in the 70s. And I remember it, I was a teenager. And inflation was just raging, and everybody thought it was an enormous problem. And the stock market went nowhere for 10 years. It was a terrible place to invest. The bond market did even worse. And the only things that made money were gold and silver and oil, because they were all a hedge against inflation. And so if what we have next is an inflationary event based on the bond market failing and the government has to print money, I would say Bitcoin and gold are going to work fine. Stock market, not so sure. And I think I see a lot of people, including people my age, a lot of boomers, who have all their savings and all their wealth in the stock market. And to be fair, it's done great for them. Especially if you own the Mag 7. I mean, good Lord, you've had enormous rates of return. But, everything in markets ultimately, I think, reverts to the mean to some degree. So, there'll be money printing, and it may not, I don't think stocks are a bad place to be. I just don't think they're as good as everyone thinks, because I think everyone's looking at the last, from 08 to present and saying, well, we're going to have that's normal. And in my view, if you look over 50 years, that's not normal. That's abnormal.
One of Lepard's more sobering insights is directed at young investors. Many have never seen a real bear market. They think stocks always bounce back, especially after the money printer goes brrr. But he reminds us, from 2000 to 2002, the Nasdaq dropped 80%. From 2007 to 2009, stocks lost 50%. And in the 1970s, amid high inflation, the market went nowhere for a decade. Don't assume the past 15 years are the norm. Please like and subscribe.